also, the market did nothing for the first many hours, and then starting 230, 240, there was a spike when we ended about 80 points higher, largely thanks to Reliance. There's still some time to go. We'll see. But 40 on the screen for now. Jigar Mistry is with us from Buoyant Capital. Jigar, good to have you with us here. Thanks very much for your time. You've been advocating some caution for some time, especially in the small and mid-cap space as we begin 2024. So just run us through some of the reasons why you feel so strongly that, one needs to take one's foot off the pedal with regards to exposure in that space. And alternately, what would you do now?
Hi, Prashant. Thank you as always for inviting me to the show. It is increasingly looking like we are borrowing, a lot of returns from our future. November, December, we have seen markets, broader indices move up something like 14%. Only thrice post the GFC, I can think of this having happened. One clearly is during, the 2013 rally post the sort of fragile five. Then we have seen it post COVID, and now is the third time. And I think the two reasons which are broadly given that explains this is how BJP winning states increases the chances to form a stable government at the center, and Fed looks like it appears that it has taken the foot off the pedal and will start seeing rate cuts again. I think with both those scenarios, it looks like that the probability going into it was non-zero. So, increasingly, I do not really think the way stocks have run up is the way we should have gone about doing this. A lot of stocks since March 2030, 250 to be precise, have gone up more than 100% or so. 3 or 4 of them have gone up 500% or so. And I think it is increasingly appearing like people are throwing a little bit of the wind to the caution to the wind rather. So I think we want to believe that market always rallies in one cycle, but I'm happy to sort of give out the data on how in that rally it looks like things will go just one way, and then something non-meaningful occurs and we sort of reverse the things around. So I think that's where we are, and we have had a beautiful rally so far. Let's not push our luck beyond a point and try to take some foot off the pedals.
We had the gentleman from CLSA, Vikash, earlier on the show. I think it's that kind of day where our experts are telling us, don't be too greedy. The theme of his note is greed is not good. So I think you're saying the same. Let's not push our luck, right? Jigar, afternoon. So just give us a sense on how, you have structured the portfolio right now. Did you take some money off the table? Have you made any changes in the last couple of weeks? And what's the positioning now, looking at the events that lie ahead?
Good afternoon, Surbhi. So yeah, I think it's the same thing. Take some money off the table. We run managed accounts, which means new money can be run differently from the old money. And clearly in accounts that we are getting newly funded. And that's the thing with sort of the good markets, right? The flows actually go on much higher. And then we are communicating it to everyone that will take time to get fully deployed. And in the older accounts, we are creating some amount of cash as well. And lastly, I think cycles sort of are not just visible at the sector level, which is very, very prominent as we speak, but even in the market cap level. So if we were talking somewhere around April, May, we were 65% small and mid cap. People were still happy buying debt products and life insurance post budget changes back then. Today we see that number in the December fact sheet below 35%. So I think with a lot of small and mid caps, especially, liquidity means a lot, right? You can only sell at a time when liquidity is sort of so buoyant, for a lack of a better word. But once the market starts sort of getting into its own drive, the liquidity dries up materially, and then you find it very difficult to get out of the businesses which have run up a lot. So at least for a fund like ours, we would want to believe that a healthy mix is important. But bottom up, a lot of businesses, money and capital is being thrown into businesses which are not making a lot of sense. For example, two-wheelers, right? 100% sort of moves in some of those names in the wake of tepid volumes, sort of embedded value. EV might account for 80% of sort of incremental sales in the next 5 years. And we are essentially building in that the profitability of both of them will be similar. So I think sort of IT, auto, to some extent utilities, And there are some sectors which are really expensive but decent, like capital goods, some small and mid caps. So idea is to sort of tilt the portfolio to more or less brace for impact rather than look for the next multi-bagger.
Hi Jigar, good afternoon and good to see you in. Jigar, do you all have any exposure to the wires and cable space?
Hi Nigel, good afternoon, good to see you as well. We have RR cable. I think that's something we added, I think a couple of quarters back. But I think that's about it. It's not a very large position. I think what's happening with the news around Polycap today is that people are maybe extrapolating the fact that whether this is an industry norm and whether this is how exactly the business is done, sort of that will likely have an impact on the sector as far as we can tell for the next few months. And unless this becomes a widespread issue, there is not really, as far as the exposure that we have, we don't think that's a meaningful impact as of today.
You know, Jigar, Polycap is down from 5,600, 5,700 to 3,800. Now, the growth that they're talking about could very well continue. This obviously will be a bit of an issue, and this is what raises some corporate governance issues, you know, because of the kind of news flow. The management, we're still to hear from them officially and for them to come and clear the air, particularly on what we heard last evening. How would you approach it? You know, since you already have some exposure to the space and the growth story could look good, does it provide a buying opportunity? Either RR cable, since it's down 5%, or a Polycap?
Right, Nigel. So I think, see, one, we need to sort of take a step back and look at where, yeah, it's an interesting space. But would say a business like this deserve a valuation or a market cap which is higher than, say, ICICI Lombard, right? Sort of a player that's building into this space versus you compare the largest sort of GI business and that's available at 65,000 crores. So there are a lot of businesses which we may want to sort of take a step back and decide on where the incremental capital needs to get allocated. Having said that, yeah, you know, sort of the other cable companies have fallen without a reason which can directly be attributed to it. So we would tend to sort of look at a lot of these businesses, but a broader, meaningful allocation of capital to businesses where, you know, the valuations are way ahead of what we think is fair needs to be sort of tapered down a little bit, I guess.
Jigar, one of the areas where you think things have gotten a little ahead of themselves is utilities, right?
Right.
Why is that? I mean, are you talking about the entire power space, the value chain, or just pure utilities?
Largely the power chain, Prashant, because the sort of, and maybe this is, you know, some reminiscence of being the utilities analyst for a very long time. But you look at the power chain in India, you have coal mining, generation, transmission, and distribution. Now, the first three part of that chain is covered under the central laws, and you have both private and public participation. Distribution is predominantly, there are a few circles which are privatized, but predominantly a state subject. Now, the key question in this sector is whether politicians take electricity to mean that as a ticket to their re-election to the state, or it is considered to be a commodity which is fairly priced. I think in that sort of tyranny between the federal and state politics, distribution sector has seen several rounds of, you know, it trying to get upgraded, like 2012 APDRP, 2015 Uday 1, 2019 Uday 2. And as a utilities analyst, I was excited every single time, but increasingly it looks that the systematic solution to this problem is not present. And in that scenario, the long-term PPAs will not be signed. You can keep trying to apply bandages to sort of a bullet wound, and that will make some companies good at some points and not at others. But the system solution is not in place, in which case most of these businesses have been re-rated. Some of them are actually second derivative, that there is a power deficit, which means, you know, NTPC will sort of make more power and therefore BEL will get more orders. But that, I think, is stretching it beyond what is, at least I would consider, normal. So we would want to wait and see whether this is a sustainable solution is present for the sector, in which case this will start making a lot of sense. Otherwise, I think we have seen the best of the times for utilities as of now.
Okay, all right, Jigar, we will leave it on that note for this afternoon. Thank you very much for joining in. Appreciate you.